finding a way to get around maybe some of the limitations either in your employer plan on Roth 401k or in your own personal Roth IRA income limits. Guess what? The government's trying to get rid of it, right? So you've got to know how to do backdoor Roth conversions while we have it. Folks, this is Colin Richards, president and founder of Lord & Richards, and this is a segment you're not going to want to miss. Today, we're going to talk about how to prepare in advance for zero taxes in retirement. That's right. You heard me, zero taxes in retirement. You say, well, there's a catch, there's a gimmick. Well, the reality is there may be money that you already have that's going to be taxed in retirement. And the question today is, what can we do about that money, as well as any other money I'm earning and saving and setting aside over the coming years? So here it is, how to prepare in advance for zero taxes in retirement. And you know what we're trying to do is we're trying to pay taxes on your terms. It's not really about getting out of taxes. It's about paying less and potentially zero in retirement rather than being a victim of the constantly changing tax environment. Pay it on your terms, not on the IRS's terms. So let's start with strategy number one. You need to contribute while you're working to tax-free investments. Contribute to tax-free investments while you're working. Now, the government is always trying to limit this. So that automatically means I'm interested. Anytime the government is trying to shut something down that's a benefit, I'm very interested in it because it probably means I'm going to save on taxes. So you already know a few of these. Let's rattle off some of them. How about a Roth IRA, right? You can start a Roth IRA if your income is within a certain limit. Now, what about at work? Well, you should be checking with your employer and seeing if you could contribute to what's called a Roth 401k. Now, when your company matches, if they do, their contributions are going to be just like a regular traditional tax-deferred 401k, meaning you're going to owe taxes later, but we can do something about that. But your portion is going to grow tax-free in that Roth environment. The Roth IRA, the Roth 401k means that you contribute money that's already been taxed. You don't exclude it from your taxes this year. You say, well, Colin, now that's starting to sound like I'm paying taxes anyway. Remember what we said, we're paying on your terms in what we've already shown in our previous segment is a historically low tax environment, an historically low tax environment. And that is going to change. The inevitability of rising taxes is there. And then how about this one? Some people call this a Section 7702 plan. That sounds real sophisticated. All it is just like 401k. It is the section of the IRS code that deals with life insurance. Did you know that there are ultra wealthy people, and we work with many of them at Lord & Richards, who have found a way to shelter their money from future taxes, and they're not limited in how much they can put in. You can put in any amount depending on what you qualify for. That money can be protected from market losses. It can grow at a moderate or a fast rate, depending on the type of investment, and it grows tax-free and can be accessed down the road tax-free. Phenomenal plan. We'll do a whole session on that one. And then fourthly, a double tax-free municipal bond. That means you're not paying state or federal taxes. So those are our 4 places among perhaps some others, but those are the 4 simple ones that you can get going on right now. Contribute to your Roth IRA, contribute to a Roth 401k if your plan allows it at work, contribute potentially to cash value of life insurance to grow protected and tax-free, and then look into the current rates on tax-free municipal bonds. Now, what else can you do? Well, once you're in the trap, in other words, once the government has lured you into using your traditional tax-free investments like traditional IRAs and 401ks, you can take advantage of what's called a backdoor Roth conversion, okay? So what does that mean? It means that you take your traditional IRA and you convert part of it to a Roth, paying the taxes now. And the idea is to not let it grow too much before you pay those taxes. So you're basically finding a way to get around maybe some of the limitations either in your employer plan on a Roth 401k or in your own personal Roth IRA income limits. You're getting around that by making a traditional contribution, but then turning right around and converting that to a Roth IRA. Guess what? The government's trying to get rid of it, right? So you've got to know how to do backdoor Roth conversions while we have it. And then once retired, now you are in a position to control how much taxes you pay. First of all, if you got all these tax-free income sources, that's completely off the radar. Money coming out of your Roth, money coming out of your life insurance, double tax-free bonds that you're going to live on, no taxes, no taxes, no impact on your Social Security check. Awesome, awesome. There's some things you can't control. If you're getting a pension, that's going to be taxed at ordinary income. So depending on the size of your standard deduction at the time that you take it, you may be able to defer a good amount of that. Also, if you choose to continue to work, one of you continues to work, that will add taxable income. But here are some items that you can control. You can choose when to take money out of your taxable or tax-free accounts. You say, well, shouldn't I just always do tax-free? Well, no, there may be years where it makes sense to take some of that taxable money because other income sources are low, right? This is where it's key to have a written, comprehensive plan, a tax plan where we can help you make sure you don't overpay taxes in your lifetime. Then you've got some things like ordinary interest and dividend income that you pay always, ordinary income tax under current law. You can control when you realize those. Capital gains, that's a favorable tax bracket compared to ordinary income. Maybe you can take a little bit of that at the appropriate time. And here's a tool often underutilized when your stocks or the value of your portfolio is down, which I hope it never is, but it's likely to have a section that is down. You realize a loss and offset some of your capital gains. You can offset some of that taxable money. So that's called tax loss harvesting. Realize a capital loss, offset some taxes. And you can also determine when you're going to claim Social Security to maximize its impact, both as an income source and minimize its taxes. You can control that. Here's the key. A tax rate of 0 is so powerful because of the math. If taxes double down the road, you still pay 0 taxes. I love this statement by Judge Learned Hand, the most quoted judge in appellate court history. He said there are 2 types of tax systems in the country, one for the informed and one for the uninformed. Well, folks, now you're informed. I'd like to help you. Just pick up the phone, give us a call. I'd love to talk to you about how you can reduce your taxes to 0 in retirement as part of a comprehensive plan.